How do investors actually measure the sustainability of taking out the trash, right? It's a fascinating question. When we think about the waste management industry, it's so easy to just picture our local recycling bins or a loud garbage truck. But for the global financial markets, evaluating this industry requires deep, standardized data. Welcome to this explainer. Today we're going to decode exactly how investors track, measure, and standardize the sustainability of the waste management industry. So to understand how we measure all this data, we really have to look at who makes the rules. Back in August 2022, the International Sustainability Standards Board, or ISSB, stepped in and assumed responsibility for the SASB standards. Think of these standards as a highly detailed financial map. They provide the global framework that guides companies on exactly what sustainability data they need to report to investors, ensuring everyone is finally speaking the exact same language.
And just to give you an idea of how comprehensive this financial map is, there are exactly 77 distinct industry-specific standards in this system. It really proves how nuanced and tailored this framework is. You can't measure a software company the same way you measure an airline, and you absolutely can't measure them the same way you'd measure a waste disposal facility.
Okay, here's our roadmap for today. First, the SICS framework explained. Second, inside the infrastructure sector. Third, defining IFWM. Fourth, tracking environmental impacts. Fifth, measuring the human element. And finally, the circular economy transition.
Section 1. The SICS framework explained. The financial map for sustainability.
SICS stands for the Sustainable Industry Classification System. But here's what you really need to take away from this. It categorizes industries based on specific sustainability-related risks and opportunities that actively affect cash flows and the cost of capital. This is absolutely crucial. This framework isn't just about looking green for the sake of good PR. It is fundamentally about tracking the environmental and social risks that will directly impact a company's bottom line over the short, medium, and long term. So if we've got 77 different industries categorized by financial risk, you're probably wondering, where exactly does trash fit into this map?
Section 2. Inside the infrastructure sector, laying the groundwork.
Waste management sits right here, squarely inside the infrastructure sector. Which makes perfect sense, right? This is the broad category housing the industries that deal with the physical foundations of our society. Without it, everything else literally grinds to a halt. Within that sector, waste management is given a very specific designation, IFWM. Oh, and by the way, the updated version of this standard that we're decoding today officially kicks in for annual periods beginning on or after January 1st, 2025.
Section 3. Defining waste management, or IFWM, more than just trash collection. Now that we know where it lives on the map, let's actually define what constitutes a waste management entity under this standard, because trust me, it is so much more than just trash collection. Just look at the sheer breadth of activities these entities are involved in. Sure, they collect, store, and dispose of municipal and hazardous waste, but the major players are often vertically integrated, meaning they own the whole shebang, from the local collection route all the way down to the final landfill. Beyond that, a huge segment operates complex waste-to-energy facilities, and some even act as environmental engineering and consulting firms for giant industrial clients. The standard has to somehow account for all of this complexity.
Section 4. Tracking environmental impacts, emissions, air, and landfills.
Look, waste management has a heavy, undeniable environmental footprint. There's just no getting around it. But what this standard does so brilliantly is turn the chaotic, messy realities of the environment into structured, perfectly comparable data for investors. Instead of vague promises about reducing pollution, companies have to report precise numbers. They disclose gross global Scope 1 emissions in metric tons. They track the exact percentage of alternative fuel vehicles in their fleet. They physically map out their facilities near dense populations to gauge air quality risks. And they report their total toxic release inventory just to keep tabs on hazardous waste.
But when analyzing greenhouse gases, investors have to weigh a really interesting trade-off. See, Scope 1 emissions are the direct, immediate emissions from operations. We're talking about the methane coming right off a landfill, which is roughly 28 times more potent than carbon dioxide, or the gases from a waste-to-energy facility. However, companies also track life cycle emissions. For example, a waste-to-energy plant might actually spike a company's short-term Scope 1 emissions today, but it drastically reduces their long-term life cycle emissions by keeping that waste out of a landfill forever. Companies have to explicitly explain how they evaluate these trade-offs in their long-term business strategy.
Beyond just greenhouse gases, the standard also heavily monitors air quality and fleet fuel.
This industry requires massive fleets of heavy, rumbling vehicles, and burning fossil fuels while emitting toxic gases, volatile organic compounds, or even just severe odors, that creates enormous regulatory risks. It's a huge financial deal, especially when these facilities operate near densely populated urban areas where local communities can very easily launch lawsuits or block expansion permits.
And we absolutely cannot talk about environmental impact without talking about leachate. Leachate is basically the contaminated liquid that drains right out of a landfill. If a company fails to contain this, it seeps directly into the soil and local groundwater. The financial and ecological consequences of poor leachate management are absolutely brutal. We're talking expensive, mandated cleanup actions, massive regulatory fines, and quite frankly, a total loss of the company's social license to operate.
Section 5. Measuring the human element, safety and labor.
We need to shift gears for a second, away from the environment and toward the human element, the people out there doing this highly physical and frankly very dangerous work. Historically, the waste management industry has way higher fatality rates than most other sectors. Because of that, having a strong safety culture isn't just a nice-to-have HR perk, it is a top operational priority that investors watch like a hawk. The standard demands precise reporting on the total recordable incident rate, the fatality rate, and the near-miss frequency rate. And here is the kicker. Companies cannot just hide behind temp agencies. These rates have to be tracked and disclosed for both their direct employees and their contract workers.
We're also measuring labor relations. The standard tracks the percentage of the workforce under collective bargaining agreements, the number of work stoppages, and the total days sitting idle due to strikes or lockouts. Why does an investor care about this? Well, labor disputes can instantly halt trash collection and shut down sorting facilities. That takes an immediate bite out of revenue, causes serious public health concerns in major cities, and creates massive reputational damage for the company. Section 6. The Circular Economy Transition, Reclaiming Resources. This final transition is all about the industry's massive shift away from simply dumping waste into a giant hole in the ground and moving toward actively recovering valuable resources. The standard meticulously tracks the exact amount of waste diverted from landfills. Investors get to see the actual metric tons of material incinerated for energy recovery, the percentage of customers getting dedicated recycling and composting services, and the precise weight of material successfully processed.
Electronic waste is literally the perfect example of how granular this gets in the circular economy. It's a two-step metric. First, the company has to measure the total amount of electronic waste they actually collected. But, just collecting it isn't enough. Step 2 requires them to calculate the actual percentage of materials successfully recovered through recycling. They have to prove they are actively pulling out valuable constituents, like precious metals, and injecting them back into the supply chain, rather than just hoarding a bunch of hazardous e-waste in a warehouse.
So let's tie all these granular metrics back to our core takeaway. Why does all of this SICS data actually matter? Because as the cost of extracting virgin materials skyrockets and global climate regulations get tighter every single year, standardized data is really the only way an investor can definitively prove if a waste management company is built for the future, or if they're just stuck in the past, relying on outdated, high-risk landfill business models.
Which leaves us with a pretty fascinating final thought to ponder. As the circular economy continues to explode in scale and everything we use gets designed from scratch for reuse, will these traditional waste management metrics become totally obsolete? Or, as the infrastructure of recovery gets more and more complex, will this standardized data become more vital than ever? It's a critical question for the future of sustainability. Thanks for joining me on this explainer.